believe we are now live here on YouTube, Matt. Welcome back to our halftime report from Tackle Trading. I think we're getting a little bit better with the timing. We'll see. I know we got a long ways to go on improving that for sure. How you doing this morning, Matt? You are muted, young man.
I was muted, actually.
Yeah.
No, doing absolutely fantastic. Looking forward to another halftime report. Last night, did a Mind of the Trader series with the pro members of Tackle Trading. And, I had an absolutely fantastic time last night with their team talking about naked puts versus credit spreads on, futures and commodities and whatnot. So, doing really, really well.
By the way, I'm looking forward to the weekend. We're going to have our fantasy football draft. Okay.
Yeah.
So aside from markets, we got today and tomorrow in the market, but this weekend I got big plans, including a fantasy football draft. And I know it's football season coming up here soon. You ready for that?
I'm always ready. I'm a two-time champion in that league. I'm always ready.
Exactly. All right. Yeah, do it now. All right, might as well. Yeah.
Hold on.
Picks or it didn't happen, right, Cody? And guess what? Matt actually has the trophy to show it. He has our fantasy football trophy. There's no doubt about it.
Hey, I just want you to know, Matt Justice. Matt Justice. There's no Tim Justice here.
It's true.
There's no Tim Justice.
Cody, you're joining our league, right?
Yes, I am. I will be joining this year, so I can take Matt off the throne.
Cody, it's called the League of Extraordinary Dirtbags.
I love it.
Yep. So I'm looking forward to it. Fantasy football, it is amazing how much fantasy football has grown. If you compare fantasy football in the last 10 years to a stock and its growth over the last 10 years, what would you give? If fantasy football was a stock, what stock would you compare it to over the last 10 years?
Well, it had incredible growth for about 7 or 8, and then it's kind of plateaued, in my opinion. So what's the stock in Tesla, maybe? Fantasy football is like Tesla because it's been stuck in a range now for a couple of years.
Fantasy football has funding secured.
At 420.
At 420. At 420. I don't think it has slowed, Tim. This is $1 billion industry every single year. It's growing exponentially. I would actually compare it to. I would compare it most likely to a Facebook.
Yeah, maybe. What's interesting, some of the laws that's been passed lately, I know that you can now do some sports betting in some of these, states like New Jersey, I believe. And I didn't really, there are some publicly traded fantasy football stocks. Cody, find me the ticker symbols for some of those companies, and maybe we'll take a look at them and talk about them. Random.
Now that you have legalized gambling on sports, DraftKings and, those types of daily fantasy sites and whatnot, it started as this dumb game that just the nerds did, but it has grown exponentially year after year after year. It's amazing. It's fun. It's entertaining, but I'm looking forward to it again.
Interesting. I'm gonna have to dig into this now because if there is an opportunity to trade them, I'll be much more interested in that than any of the fantasy football teams I draft. As much as I love football, that's for Sundays. The markets are for the week, and that is my true passion. Let's go through the market here, Matt. The S&P 500 at 2858, showing strength, breaking out. We've been testing the highs. What was the highest price we hit here today, by the way?
The high of today was 2862.75.
So we're still about 16 points off the high. It keeps flirting with it. Do you think we're going to get there by the end of the week? Here we are Thursday, another sleepy day in the market. You haven't had much going on. And by the way, we started the week talking about that. And if you're out there as a trader and you're thinking, well, yeah, it's a boring market, that's okay. There's always a strategy. It's been a great week for cash flow, Matt. And if you're a cash flow trader, you love sleepy markets. What's your take on the candle on the S&P here today?
It's just honestly, it's a rehash of yesterday, Tim. Not a whole lot of economic news coming out today. Hardly no earnings reports coming out today. No geopolitical situations today, and I do think the market's very resilient to any of that same conversations that we've had. I mean, you can say trade talk, tariffs. You can talk about that all day long, but we hear it every single day, and so the markets just really don't care about it right now. It's just another very lackadaisical, boring day in the market, and there's nothing wrong with that. Earlier in the week, I felt like we were going to reach those all-time highs. I still believe we're going to reach those all-time highs. But tomorrow we have CPI report, not a major indicator, I would say. I don't expect anything dramatic to happen with that report. So, we could have another boring day, but I fully expect it to hit in the next few days.
For sure. And, the thing about these inflation measures, Matt, they've been mostly in control. We're going to talk a little bit about this later in the show. President Nixon stepped down today, and in the 1970s, they had inflation at 8, 10, 12%. Our inflation right now is 2-3%. So these CPI and PPI numbers, we're in line with what a Federal Reserve would want to do.
We're in line with what the report indicates.
All right.
That's not a true indication of inflation, but we are in line with what the report says.
Cody, find me a publicly traded company that sells tinfoil as well. I want to look that company up by the end of the show for sure. All right, let's move on to the volatility index. Let's give it a quick peek, okay? Because we keep talking on sleepy markets, we're going to be down here at 10. Matt, I worked my butt off this week trying to find a trade on the VIX, and I cannot find one even at these prices. None of the bear calls work. None of them work. I can't justify it. We'll revisit this another time. I'm giving you the lead on that conversation from our recent podcast. Table it for later. Let's move on to the different indexes, RTY, YM, and NQ. About to break out, Matt. This would be a fascinating development, in my opinion, because so many of the small cap companies are where the market is going to give you the opportunity on a run. If you broke that resistance there, Matt, you have to go long RTY, which means you probably need to hedge condors if you have it on there. What's your read on the Russell?
The Russell right now is still lagging the other major indexes, the Dow, the S&P, as well as the NASDAQ. However, the one thing that you can expect on the run is when it does break, it runs faster than the other indexes do. It can catch up is what I'm saying. So if it breaks out of this level of resistance right here at 1720, it's not going to do it today by no means. It's only at 1696. You'd have to see, another complete, one ATR day up here to see it even remotely touching that resistance level. But as you can see, every time the Russell breaks out, it does run fairly aggressively. We've seen that in the recent history of the rut. As you can see right here, breaks out, runs. As you can see right here, breaks out, runs. If we go back in time just a little bit, right here, as you see, it breaks out, it runs. And so when the Russell does break out, that small mid-cap index does have a tendency to move fairly aggressively. And it's just, the simple reality is it's easier to move a small and a mid-cap index than it is a blue chip index. They're bigger. The blue chip indexes are bigger, so they don't run as fast. So if you're looking for a potential trade on the breakout, you're looking at the Russell 2000 here, and you're getting a little excited to see that get above 1720 because it certainly can run. If you do trade that cash flow condor system with iron condors on the Russell 2000, if it does break out, yes, you might want to hedge that.
I'm going to hedge. Tyler and I, we did a cash flow condor mastermind group last month, and I really enjoyed it. One of my favorite things ever, Matt, is to sit and talk with other traders, just like this show, and I was talking to Tyler about that with our team. And cash flow condors is a premium trading system. It's the kind of thing that it's deep dive into education and then application. And Tyler and I were having a little bit of a debate or a discussion about whether to hedge or not. If you have a pro account on Tackle Trading, go watch that replay. That's all I'm going to say. I can't do it justice. It's 90 minutes long.
And I would not hedge until the breakout, though.
That's right.
So, as long as it's underneath 1720, there's no reason to do anything here.
Well, but there are like 2 or 3 different things to do. And frankly, one of the skill sets I believe traders need to develop out there, Matt, is forecasting risk management, okay? And so having a plan, instead of waiting for a break at 1710 and then saying, now what do I do? You could spend 10 minutes in an analyze tab and actually just start to plot out based on your trade, all of the different scenarios. Critical thinking, problem solving, being creative. I think those are all important skill sets for any trader.
Well, it goes back to the old Boy Scout model, right? Be prepared. And so if the Russell does in fact break out of 1720, you should know ahead of time what you're going to do. Even if that is, I decide to do nothing because maybe I'm selling the $1,800 bear call spread, right? So if I'm selling the $1,800 bear call spread, I might not do anything. But if I'm selling the 1750 by 1760 bear call spread, at that point, then you have to do something because you're only, 1.5, 2 ATRs away from your strike price. So it depends on what you've sold, obviously, but you should do exactly what you talked about. You should go into that analyze tab. You should project out different hedging techniques. And if it does break out and you need to hedge, you are ready to do that. You don't have to do any real thinking about that. You simply take action.
By the way, we've got some of our regular halftime crew, and we might even create a new name. It's the halftime crew here. If you're here with us live, just say hello. Looks like Jacques, Daniel, Maria, a lot of my Emily, yeah, a lot of the halftime crew are here. And also give me a quick thumbs up and share. Let's see if we can hit our high watermark for live attendance on this show here today, Matt. RTY showing relative strength here, 0.59%. That green candle is better than the ES.
Well, you got a couple stocks that are really, driving that today. Roku's coming out of earnings, responding really well coming out of earnings. Yelp responding amazingly coming out of earnings. So you had some earnings reports today that gave the small and the mid cap index a little bit of boost.
Yeah, for sure. Yeah, and there's a lot of companies on that index that when they do pop, Matt, they can pop 20%, or even a real strong candle on stock like Spotify is going to be 4 or 5%. So they have the potential to make those big moves.
Well, you look at just a couple of those stocks you just named here. Roku breaking out of a resistance, reported earnings here today. Came in at actually a lot better than what was expected. Was expected to show a loss again. Came in at break even. That's a very positive step for Roku. It's had positive reports in the past, but mostly showing negative numbers. Approaching the all-time high on Roku. I wouldn't buy after the movement, but this is a stock that you may want to put on your watch list to watch over the next couple of weeks to see if it can get back up above that all-time high. That would be a very good buy signal. We mentioned Yelp here. Yelp just had a tremendous day here, reporting on its earnings. Was in a bearish downtrend, gaps up above the previous levels of resistance. That close above that level, you could see Yelp start to run as well. And then Tim, you mentioned Spotify very quickly. Didn't have earnings. Earnings was last week, but came back down into a support level. This is a stock that's been very consistent on its trend. I remember talking about it back here, Tim, when you were like, I like that retracement back then. Yeah, it showed continuation here. You're seeing a very good pullback coming back down into two rising moving averages. Big movement on today, up about 5%, breaking all intraday and daily resistance levels. So you're having a good day in the Russell 2000 in comparison to some of the other indexes. Watch these stocks. I would put all three of these stocks on a watch list to watch over the next couple of weeks, with Spotify obviously being one that's setting up right now.
Spotify is tradable. The hard thing is you're up 4 or 5% now, but here's the thing. You've got tons of upside. Pay range expectations, Matt, would put your targeting at 200, 210. Definitely those they went exactly on my watch list. When you said that, here's the thing, guys. When you have a developed system, just keep your list open. If you see a stock that grabs your attention, write it down or put it in your Thinkorswim watch list, whatever it is you're doing. Matt, I've got a list I'm calling August watch list, right? Because it's August. I'm not that complicated of a guy. And I added Roku, Yelp, and some of those that you just mentioned. I already had Spot and Dropbox on there, but yeah. Spot's a great trigger there today, no doubt about it.
Yep. I think your target of 200 is a good initial target. It's a previous all-time high. If you're looking at it based on pay range, and for those of you who are not familiar with pay range, basically pay range is just an analysis of the previous two price movements. So if I'm looking at the previous two price movements from support to resistance and from support to resistance, you're looking at those different pay ranges. So your first support to resistance goes from 150 up to about 181. That's a $31 price movement. Your second price movement goes from 165 to we'll just call it 199. So 165 to 199 is $34 price movement. So you're talking somewhere around a $32.5 price movement on average. That goes from this level at 175. So if you're looking at your potential pay range, you go from support plus your potential average yield of 32.5, and that gives you a potential target at 207.5. So your first target would always be, and this is just kind of how I do it, First target, I always want to target the previous level of resistance. That's 199. So your first target is 199. The secondary target based on potential average yield would be 207.50, 207.50. So yeah, that's you're looking at a stock right now at 187, $10 on the potential first target with about $20 on the potential second target. It would be really, really tough where to place a stop loss, because typically where I would want to place a stop loss is all the way down under here at 175 where the support level is. But if I put a stop loss all the way down under here under 175, I can't make a reward to risk ratio work. So you would have to get a little creative with the stop loss, maybe drop this down into a 1 hour chart, find a level that you're comfortable under here, some support level, maybe at 182. You also have some support down here at 179. So you'd have to look at an intraday support level you're comfortable putting a stop loss under, simply because you have a real big price movement today. You're getting in at the tail end of the price movement. You got to be a little creative with that stop loss.
Sure. And sometimes you can keep R2R working when you get creative in the option spread too. But I love the analysis. I think 200 as an initial target is something you can definitely start with. But Matt, if the trend is working for you, you don't panic at your first target. You say, hey, we're great. We're hitting our first location, right? And then you do an adjustment, you scale, you do something with it. But,
you don't get out unless you see a lot of slowing momentum. You don't really get out. You do two things. Number one, you trail up the stop loss to lock in profit. And number two, you might scale out of your contracts.
For sure. All right. And I do want to look at Amazon. Might as well do it right now while it's on my mind. And then we're going to get into the other indexes, the commodities and all that kind of stuff. Shout out to my buddy who I know he's traveling today. I saw
Big Cat.
Him at the Market Street Grill there at the airport, Matt. I know exactly what he orders.
Well, you've sat there with him a few times.
Many times. He's my travel buddy. And he is long Amazon right now. He sent us a text last night, and Amazon's killing it here. Another up 0.85%. The basic question, and I don't, Steve's a 30-year veteran of the markets, but it's the same question. How far can something run, right? And Matt, you gave him great advice. Listen, it's overvalued, but the market, it can go up for probably at least 2,000 would be a target, don't you think?
Well, when I asked him, I said, is this a swing trade or is this an investment? I mean, because that analysis is different. And what he was talking about was more like an investment, right? And I said to Big Cat, I said, listen, by any traditional fundamental measure, Amazon is overvalued beyond means. I mean, for the current valuation of Amazon, it would take 20 years of 30% growth compounded for them to actually be a fair valued company. That is a bubble stock is what that is. However, this market doesn't care about that in any capacity. It does not care about that. Sure. This market wants to buy. Amazon wants to buy. It's focused on the technicals. It's focused on the growth. And I just said, you know what? 2,000 feels like it's going to get hit.
It almost is one of those.
It's that feeling again, Tim.
Group consciousness things. Yeah, for sure. I mean, it's just a big round number. Same thing with Apple and 200 when it was going to test it, right? I mean, we could have the same conversation.
Well, not only that, but 2,000 is a technical, psychological level, number one. Number two, if you look at your potential average yield, that puts you right into about 2,000 as well. So I didn't just pull 2,000 out of nowhere, but it does have a psychological component to it, and there are technical conditions there. But it wouldn't shock me to come back in 2 weeks and see Amazon at 2,000.
I want to have a quick public service announcement. Pull up PTLA. Okay. PTLA is a drug stock that had earnings last night. I don't trade it, but I saw it in the news, and it's just a reminder. Drugs are bad.
Don't do drugs.
Don't do drugs. Don't trade stocks that have random gapping and volatility around earnings. You got to do your prep. Stock dropped here, Matt, $7 on a $38 stock, about 20% down. You look at some of the gapping in the past, though. This is always really concerning when I look at a chart like this. The gap happened 4 days before the previous earning. Okay, so how do you even predict that? Sometimes it's on earnings, sometimes it's not. Sometimes it gaps. If you have craziness, the only play you could ever do on something like that is bi-directional, right?
Oh yeah. First of all, There is a old cliche in the market that says don't do drugs.
Mm-hmm.
And what that means is you never want to trade or invest in a stock that has the miracle cure for whatever disease you're looking at, right? You want to, when you're looking at the drug companies, Baidu, Amgen, Pfizer, Merck, these are massive, massive companies with massive amounts of different, medical prescription drugs. That's not what we're talking about. We're talking about the smaller, mid-cap, small-cap stocks on the drug perspective. They're just too random, and they lack all consistency, in my opinion.
Pull up PAAS, which they do have liquid options, no weeklies, but they're liquid enough. One of my favorite silver companies to actually keep an eye on. They had earnings last night, Matt. They jumped up real aggressively. If you're looking for something in the metals, area to actually get behind and show strength, this one did have a nice little earnings gap out, 9%.
As a real kind of neutral here, don't mind this setup on the weekly chart here, Tim. Seeing higher highs, higher lows on the weekly chart over the course of the year. In comparison to that on silver, this might be a real good find, Tim. In comparison to that on silver, on the weekly charts, we're seeing lower lows, lower highs at the low. Here on PAAS, Pan American Silver Corporation, you're seeing the inverted type range here. Over the course of the last couple of years, it's really neutral. But over the course of the last year, especially 2017 coming into 2018, you're kind of starting to see a little bit of strength here. That's a good find right there, T.
Some of the energy stocks, oil stocks from last night, Occidental, OXY, Murphy Oil, MUR, they're showing weakness today. Energy has some mixed action here today, obviously, but keep an eye on those. Then there's some today after the bell, Matt, that I think are really important to keep an eye on from a trading perspective. One is Dropbox, okay, DBX. And this one's on my list. It's been on my list for a while. I use Dropbox. I like Dropbox. I like the company. I want to trade this company. I don't have a trade on it. I don't know what to do with the earnings here, but that candle is incredibly strong.
It's up 7% before earnings, Tim. Yeah. It's up about 20% in the last week before earnings. Obviously, there's some belief in this stock coming into it. Volume's been fairly, slightly above average coming into it. That's a little abnormal coming into an earnings. The expectation on Dropbox is it's going to move about 10%. It's going to move about $3.4. So with the movement coming into earnings, I think you could actually see a little bit more movement than we typically might see. We've only seen one earnings report with Dropbox. It did have a little bit of a muted response, came down just a little bit. I expect it to move fairly aggressively, especially in light of what the movement has been in the last week.
It's expecting a 10% gap, guy, and it's already up today 7%. I don't know. That's going to be a tough one to play. If you're long the stock, Matt, you probably have to buy the insurance, and Delta hedge that. Do you agree?
Oh, absolutely. Yes. If you own Dropbox as an investor, it is important that you hedge this.
Yeah, and so that would be a put option. And if you're an investor, you need to go out and have your rules and apply them and all that kind of stuff. If you're in a covered call, you've got to collar it. If I'm in a covered call, I might take the short call off, though. I don't like holding a covered call through earnings. I think it's one of the worst strategies you can take through earnings, in my opinion. But any trade into earnings has to have design and purpose. I don't know.
You should never hold a covered call through earnings, but there's no problem with holding a covered call with the protection through earnings.
Well, yeah, because you're collaring it. That's a different strategy. Yeah, that's for sure.
But no, because think about it. If you hold a covered call through earnings, you have limited potential on the growth and you have unlimited potential on the downside, right? So you have an inverted reward to risk ratio. You can never do that, right? It is better to hold the stock itself through earnings than a covered call through earnings. Would you agree?
Yes, okay. I would.
But if you are going to hold a covered call through earnings, which is fine, you can only do that if you also own the protection, meaning the put options, which means it protects the downside. You still have limited growth potential through the earnings, but you now have limited risk to the downside.
Yeah, and I mean there are some other companies that have earnings here tonight. Planet Fitness, Microchip, but I think DBX for me, even though it's not the biggest market cap, it's only an $11 billion company because of how popular it is and because of the anticipation of the IPO and the growth. I think it is going to be the headline here tonight, one way or the other.
I love it when it's so 2018 when you say, "Yeah, it's only an $11 billion." Get it out of here. Move on. It's only 11 billion. We're not going to trade you until you're the fake $70 billion company, Tesla.
Oh, Tesla's become your number one target. There's no doubt about it. We do have to revisit that conversation.
I believe Elon lied. Yes.
I'm tabling it until after we go through the commodities market and the currency markets. So I want you to look at, let's go through crude oil, gold, the dollar, Bitcoin. And for me, crude oil, obviously, we have to follow up on that conversation from yesterday. It got beat up badly, little green doji candlestick here. You know, some traders are going to feel a little relief and say, okay, maybe it's going to bounce back up, Matt. That's not a great candle. There's nothing there.
No, there's just nothing happening in the market today. But I do want to say something. You know, we spent a lot of time talking about that trade I had and kind of what happened here yesterday. But as you can see, the price movement yesterday got beat up pretty hard, but it still stayed above support, right? Mm-hmm. So on the beat up yesterday, it came down in support. It's holding its ground here today. This is not a buying signal in any capacity. But I do want to highlight something very quickly that I talked about on the Mind of the Trader webinar from Tapper Trading yesterday. Last night, we were looking at crude oil from not a directional capacity because I do not believe there is a directional swing trade here any longer. I don't think there's going to be a swing trade on crude for the next few weeks, to be perfectly honest with you. I think it's going to take some time to set up, right? And so in terms of this, though, I'm not going to sit idly by and not do anything on crude until it sets up again. This is where having the ability to trade different systems comes into equation. And so what I was talking about yesterday on the Mind of the Trader webinar is I was saying, okay, listen, guys, yeah, the directional trade did not work out on crude. But when you're looking at different systems, and I was kind of talking about the personal gold system, when you're looking at different systems, if tomorrow I see a small doji-like candle, you know, I may go out there and look at selling a put option on crude oil because I get massive range now. And when I was looking at Tim, and we had a really, really deep dive conversation on this. I mean, we were looking at this trade on crude for about 30 minutes. What I was looking at here is I was saying, okay, guys, listen, I still like the overall trend of crude. You know, you look at this bullish uptrend, you have support here. And I want everybody to kind of look at these support levels last night. I know we got, you know, what'd you call them, our halftime crew?
Yeah, the halftime.
A lot of the halftime crew was at the Mind of the Trader last night. It was absolutely awesome. I thought you have support right here at 66. You have support right here at 64. You have support right here at 62. Tim, you have support right here at 60, and you have support right here at 58. You have a tremendous amount of support levels between the current price and 58. If you look at this on a weekly chart, Tim, I still really like crude on the weekly chart, still a very consistent trend line on the weekly chart. But if you're looking at all those support levels I was talking about, the major support level is right here at 58. And so if I get that slowing momentum candle, and I'll probably wait till tomorrow, I would say, Tim, before I issue the put option, I'd like to see it hold for another day.
You're talking short put.
Yeah, I'm a naked put.
Yeah.
But if I can go out to the market and sell underneath that $58 put option or that $58 strike price, and I can sell this 57.5. Now it was a little better yesterday, but we're getting about $140 on the contract per contract. You have a margin requirement of about 950. Tim, that's a 14% ROI with 94% probability of success. And
I don't mind naked put here. But T. Boone Pickens himself could call me and tell me to go long crude, and I'd say no. All right.
If T-Bone called you, you should go long crude. If he called you, you should go. I don't care what the chart reads. If T-Bone calls you, you go long crude. That's what you do.
But I trade my system.
I want you to think about something. Okay. Obviously, we've seen some depreciation on the crude. Obviously, we don't like this as a directional perspective. but I got support at 66, 64, 62, 60, and 58 with major support levels at 62 and 58.
Yeah.
Now I'm going out to the market 39 days. I'm selling underneath all of that, and I'm getting 94% probability with 14% ROI.
Well, sure, but you know how to manage the expanding margin. You got to remember, futures options are leverage on leverage, where you have a set margin today, where that margin can change.
Oh, absolutely!
You know how to turn it into a spread,
coming down,
and it's a part of your system called the personal gold system. See, this is the beauty of a trader who has a system, Matt. You know how to just execute this, right? But again, short put with low delta is a very different strategy than long call or long future or a long ETF right there on that candle, right?
Well, of course it is, right? That's why you would never go long right now with a directional anything, long futures, long call. You wouldn't do that with oil right now. But if you still like the trend, if you still like where you're at, you're selling 15% out of the money. You're selling a 6 delta. You're getting 14% ROI with 94% probability. I like that trade. And if you don't like the naked put, you can also look at the credit spread where you're getting $70 on $400 buying power, which is the same 14% ROI. Either way you go about it, you can always trade it if you feel comfortable. Now, obviously, if you have never traded futures, you should never sell an option on futures. Would you agree with that?
Oh, not even close. Yeah, first of all, not even close. If you have not back tested and understand expanding risk and margins and how they work, you shouldn't trade options on futures. If you've not been trading for 6 months or a year or more successfully, you shouldn't trade options on futures. There's a process to getting into these products, and product knowledge is very, very important. There's no doubt about it. I would start with an ETF, Matt. As much as I love everything you said about crude right there, if a new trader in the first 6 months came to me, I'd put them towards USO. You know, even though the numbers aren't as good, you don't make as much money on your margin, you don't make as much ROI. At least the ETF, you could take delivery of it and feel comfortable with that.
I wouldn't sell naked puts on USO right now. You're not getting any ROI.
Yeah.
I mean, you're not getting any ROI. It would be much better to buy USO and do covered calls on it.
Yep. Either way. I'll tell you, I want to give you a compliment. I got about 3 or 4 emails, which I don't always get from our shows because we do so many shows, from students who said, I loved that webinar last night, that Mind of a Trader you did. I haven't seen the replay yet. So I popped in for 5 minutes. You did a lot of this analysis for about an hour. Is that right?
You know, we talked about, you know, we basically walked through different naked puts, credit spreads. We talked about when to enter into it. You know, I was looking at, like, we analyzed natural gas. And basically what I said here, when I was talking about selling put options and credit spreads on commodities, I was talking about, listen, you have no desire to actually take ownership of anything here, right? Sure. This is pure theta. This is pure cash flow. And when I said on natural gas here, I would never sell a naked put on natural gas right now, simply because it's already had price appreciation and I expect it to come back down. So it'd be on natural gas, it would be much better to wait for it to come back down in a retracement and then issue that put option. Because here, Tim, if you're looking at selling a put option on natural gas right now, and you're going out to say, let's just say the 10 delta 2.65 here, you're selling that right here, right under that support level. And that's going to come back down and put pressure on you. And I didn't talk about this, but you mentioned it here, Tim. If I sell a naked put on natural gas right here, just at that 10 delta, my margin requirement per contract when I get into the trade, and if I move that to the mid price, confirm and send, is $364. But that's when I get into the trade, Tim. As natural gas, like I expect, as natural gas starts to come down, what happens to that margin?
Well, this is the way margin works on futures. If it ever moves towards the strike you sold, the margin goes up. If it ever moves away from the strike you sold, the margin goes down. They set the margin based on the assumed risk, which is a function of what they look at for delta, Matt.
Which has very little risk right now because you're selling a 9 delta, 91% probability. There's not a lot of risk for this to come back down because the probability doesn't say over the next 40 days it's going to come back down here. But I do, from a technical perspective, expect it to come down, back down into support. So if that starts coming down into support, this strike price I sold right here, 265, that's not going to have a 9 delta anymore. That's going to have a 20 delta, 30 delta. And as that commodity comes back down in price, the margin is going to expand because my risk increases. So for me, it's better to wait for it to come back down because it's already ran its price appreciation. Wait for it to come back down, find a support, and then as it finds support, at that point, you can sell that put option not at 265, but then you can sell that put option all the way down here, and it's a way to maximize your range. On the flip side, on crude oil, like I was talking about, crude has already came back down. You're already sitting in a support level. It allows you can sell all the way down here at the 57.5 put option, and you have massive range between the current price at 66.99 and 57.5. So for me, if you're looking to cash flow on one of these two instruments, I'm looking at crude right now to sell put options. And if you're not comfortable with the put option, then look at that bull put spread, and that's what we talked about. Now, the difference, though, is when you sell a naked put, Tim, that is pure theta. When you do the bull put spread, that's more like a spread bet, right? You're just basically saying by expiration, it's going to stay above this level. You're not capturing the theta because you're mitigating theta because you're selling an option and buying an option. So if you're looking for pure cash flow, you're looking at the naked put. If you're looking for, cash flow at expiration, then you're looking at the bull put.
Yeah, I love it. I love commodities as well, and I love doing the options on them. I'd recommend everybody go check out that Mind of a Trader. It's about probably 75 minutes long, Matt, 70, something like that.
We're right at 60.
Did you do an hour on the button? And then it's all deep dive into this topic. So if you're interested in naked puts on commodities, whether it's the future of the ETF and the conversation, go check out that replay.
Go check out the Mind of the Trader. It's already posted to the website for the pro members. If you're not a pro member, you can get a 15-day free trial to check it out. But also, Tim, we just recently launched on Tuesday the Futures 101 course.
We sure did.
It's a 2-hour basic course on trading futures. Coach Grant Larson did it. We released it on Tuesday. So if you guys are interested in learning the real basic high-level definitions, just what are futures, what is margin, get over there, check out Futures 101. And while you're over there, check out Tech 101 and Options 101 too.
Let's move on to a conversation about currencies. On a day where China released some of the inflation data regarding the impact of these tariffs that have been going into effect, and also where Russia has had some sanctions slapped on it, the currency markets are going to be in focus. The dollar has shown a ton of strength. But for me, Matt, the Russian headline is not the headline. The lead is the conversation with Japan that is starting right now. And Japan is one of our biggest trading partners. There's no doubt about it. They're one of the major economies, and they have such a strong currency. The dollar-yen cross-pair and analysis is something that we dove into a couple of weeks ago, especially when you did the Forex report. Talk about the dollar strength here. Matt, 0.5% on the dollar. I mean, we're not talking about a stock. That still is a nice, clean.
That's a big movement. Yeah. It's a big movement on the dollar. Obviously, it's a big movement on the dollar. Dollar's showing tremendous strength here. Not only is it showing strength, but it's keeping its strength, Tim. Look at this as it's approaching this resistance level. This is something I want you guys to look at. As it's approaching its resistance level, we're seeing expanding green candles coming into resistance. It's showing tremendous strength. I don't expect it to break out. But Tim, at this point, I mean, all points lead to the dollar breaking out of that resistance level. And if it breaks out of that resistance level, Tim, you're looking at the dollar. And let me get a little bit more time frame because we're breaking out of important resistance zones here. So let me get 3 years of data here. So we're breaking out of this level right here. Next level you're looking at, Tim, from a currency perspective, any major support level, you're probably looking up here at about $98. And so if we're looking at a breakout here, price appreciation could come back up into that $98. It reminds me a lot of what we've talked about with crude over in 2016, 2017, as crude was starting to find its way coming back up after crude's bearish downtrend in 2014, early 2015. You're starting to see that same thing happen with the dollar here. A breakout of 90. Let me give you a current price action, 95.5. A breakout of 95.5. That would be a significant breakout, in my opinion. And so obviously you're not looking to trade the dollar index, but at that point, if you might want to go look at some different currency pairs to find something that you might want to trade. I mean, remember, Tim, when we were talking about the potential breakout on the euro dollar of 118, it ultimately never did that. But Tim, you have a very important support level right here at 115 on the euro dollar. A breakout of 95.5 on the dollar index would most certainly lead to a breakdown on the euro of 115. That's a potential opportunity on the short side on the euro. Looking at here on the British pound, the pound is showing tremendous weakness out of last week and the Brexit conversations. It's broken its channel that was very consistent. It's now getting absolutely slaughtered here. A breakdown of that 130 mark, you'd probably wait for a retracement.
I'm going to say something right now. People got to learn to take action. You know,
do.
I hear this all the time, and I'm the same way. We all are the same way. We have an instinct to be afraid that we're missing, out, or we're making the wrong entry or whatever it is. That pound dollar cross pair map, 400 pips, you would have had an incredible ROI on that trade had you just taken a swing trade on it. Now, there's a lot that went into that trade. I understand. And Forex is not for everybody. But if you know how to trade Forex, a small amount of capital would have given you the potential to swing trade that thing to the downside.
Tim, I talked about that in the Forex Report 2 weeks ago about a potential breakdown of that 130 mark. Yeah. Tim, that's 150% ROI. And you're absolutely right. It's the thing that as an educator and a trader that's taught more people than I can count, it's always been something that I don't want to say frustrating because it's not, but kind of saddening. I'll say that people, even sometimes when they are educated, they still fail to take action, right? They don't prepare themselves. They don't take action. They come at the very end of a price movement. They finally take some action. They say, oh, trading is like gambling. No, you failed to take action. You failed to apply your system. You failed to go to your classes. You failed to do these things. And we have that responsibility on ourselves to do that. But you're absolutely right, Jim. It's something that does frustrate me a little bit when people fail to take action. But it only frustrates me when they fail to take action and then they end up blaming somebody else because of their failure to take action.
I agree. You got to pull the trigger on some of this stuff. And whether or not the Forex pair is for you or not, that doesn't matter. There's ETFs you can play it with. Think about it. There's tons of different ways that you can play it. I'm very fascinated in the conversations happening in currency right now, Matt, because all of this stuff going on internationally, it's going to drive these markets. It just makes more sense, obviously.
Well, the two currency pairs I would take a look at specifically on a breakout of the dollar index is the US dollar Japanese yen pair and the euro US dollar pair. Those two pairs are the ones I'm looking at potential trades here.
I love it. All right, very good. Let's move forward and kind of talk a little bit about that Tesla stock. I did table it. I want to bring it back. We have to follow up on that conversation. The market is coming back on this one here, Matt. Maybe they don't believe in the 420 funding price. I know you have a very, very strong opinion about this. I want you to take it from this perspective, though. Okay, is there anything here to trade? No. If you're looking at this and you're thinking, okay, I want to do something with Tesla, is there any potential on a trade on Tesla?
No. Well, I don't want to say no. Bidirectional, yes. Bidirectional, yes. There's no directional trade here on Tesla, in my opinion. Okay. If you own the stock, you should own put options. That's the only thing, and that makes it a bidirectional trade. You might even want to ratio backspread that trade by buying two options for every 100 shares you own to make that nice little V-shaped risk graph. So basically, when you buy a stock and you buy a put option against the stock, it creates this L shape, right? When you ratio it by owning 100 shares and buying two put options, you create that V shape. So let's say, I own the stock, right? And a lot of our community does own Tesla stock. You and I have owned Tesla stock in the past. I don't own any Tesla stock right now, but if I own 100 shares of Tesla stock and I buy one put option, just to kind of hedge. And I just go, we'll just say I go to the 29 delta here. That's going to create, I didn't want to sell that. I need to buy that. Okay, there we go. All right, that creates a L-shaped risk graph, okay? You see, so as you can see here, let me get a little bit more data. As you can see, it flatlines the risk graph to the downside, right? That's what that protection does. It flatlines it at the strike price you're buying. But if I come and I say, well, let me buy 2 contracts instead of 1, it creates a V-shaped risk graph, as you can see right there. So when we talk about that ratio, that's all that means is you're buying more insurance than you have on, you're buying more insurance than you do own the stock. That creates that V-shaped risk graph. I do like that, but also if you're looking at the potential from a getting in just trading, because you think this is very, very news driven right now, a straddle play on it does make some sense to me. Maybe not a straddle,
probably a debit con,
but perhaps.
I would rather do something spread in that, because if you look at the volatility spiking to 65%, buying options at 65% implied volatility is not a great plan for your account long term. It's not going to work out very well most of the time.
Of course not. But if you expect tremendous movement on Tesla, I'm willing to pay a little bit of a higher premium if I expect that price movement. I don't expect a lot of things to happen, Tim. This is going to be a long time going on. Yes, I do believe Elon Musk does not have funding secured. And I do believe that is going to cause him massive amounts of pain in the future. I don't believe he can take Tesla private. Those things are already starting to come out, folks. I said this the very second we saw that tweet. There is something that smells wrong here. There was mistakes driven. There is no funding here. That's my opinion. Now, I could be completely wrong on that, but there is just so much wrong with what happened. And if Elon was trying to manipulate the stock price to drive it up so he didn't have to secure funding from a cash position so he could just simply sell Tesla shares, there's going to be lawsuits here. That is market manipulation. It is no different than when any other hedge fund does it, or when the institution spoofed the market, or when Jamie Dimon did that. Okay, Tim, what did we have to say about Jamie Dimon when he basically came out and tried to drive Bitcoin's price down? What did we say? We said it was wrong. That's what we said.
I think there was a little stronger language than that, but
there was a very strong language. In fact, I think there was a couple of "F you this, that, blah blah blah."
You're not a big fan. I'm not a big fan for sure.
Just because we like Elon Musk doesn't mean what he's doing is any different than what Jamie Dimon did in 2011 with the gold manipulation, or with the Bitcoin manipulation.
Due process, Matt. You got it.
Does with spoofing the market.
There are due process rules in just any time you want to think through a problem like this. You got to let it play out. I'm with you. It smells fishy, okay? But I will tell you, I think the market does not like it today. I'll tell you that. I know that. The market reacted to the information in the news. They took it from, in fact, Matt, the entire gain from that tweet you were talking about is already gone.
Yeah.
Okay. If you look at the intraday, I mean, it jumped from about 350 to 380. It's now back down at 353. So the market is not following up on his Twitter, post, right?
Well, it doesn't help when the SEC comes out and says, "Hey, listen, Elon, you got secured funding? Show us the picture. Come on, prove it.
Yeah,
prove it."
Run me to tackle trading real quick. I want to take a quick look at the heat map before we have our final conversation. We're going to talk about Nixon and the 70s here in a minute. Kind of a fun one we had prepped, but I want to show you a couple things on this heat map here today, Matt. By the way, in the chat, just type in the words heat map. I think they're such an important thing to use every day. And if you're a new trader and you're looking for one tip from today, obviously just come back to this halftime report every day and you'll get a lot of information. That would be number one. Number two is go look at a heat map. It gives you a lot of quick visual information. Apple strong today, Amazon strong today, Matt, no question. Some of the big leaders in the market, Google and Microsoft following up, Facebook down, but financials are down and energy is down, right? What else do you see on the heat map?
Honestly, not a tremendous amount today, just given that we're kind of flat today in most of the major markets. Crude's flat, natural gas flat, Bitcoin flat, S&P flat. Most of the markets are fairly flat today, and so you're going to see kind of a mixture here. When I'm looking at the heat map, the first thing I look at is just kind of the radical levels. So here on Bookings Holdings, getting absolutely crushed down 6% today.
Why did they change the name on that, by the way?
What?
It used to be Priceline. Why did they change the name?
Why did Google change to
Alphabet? I don't.
Who knows? Okay, Costco down 3% today. Occidental Petroleum down 5% today. John Deere down 3.89%. So I kind of look at the radical levels. And when I'm doing that, when I'm looking at these things, Tim, not only am I looking at the percentage price change, but I'm also trying to look at the actual line graph. So if you can see that line graph, I'm doing a quick read on like the trends of these different stocks here. So for example, I look at and I'm just spitballing here.
By the way, that booking, this is why I love heat maps. I've not looked at that chart in probably a month, at least.
Well, you might want to look at it. It's getting beat up today.
Not only did it get beat up, Matt, that gap below key support at 2000, it is now breaking down on a huge move.
Oh, yeah.
That's a watch list stock right there.
Oh, it absolutely is. But I'm also looking at just from, not just that, I'm looking at the other trends here. SPGI, okay, SPGI here. Tim, look at this breakdown here. It had out of earnings, retraces back up into resistance. And that is a very, very powerful bearish retracement here. That's a potential shorting position. So when I'm looking at the heat map here, Tim, I'm not just looking at it from, percentage. I'm trying to look at the actual trends to generate ideas so I can go make some swing trades.
That's right. So those two are going to go on my list. I just added them to that. SPGI is probably set up a little quicker than booking is, but that is a key breakdown. We'll come back to that one another day. Come down and scroll through. Let's take a look at the Tackle 25 as well. Now, by the way, all that sector information you're going to find, and we always go through the indices in Thinkorswim, but they're right here as well. If you don't have a charting platform, you can always come to the website and take a peek here. Commodity markets, the ones we always go through. Come down to the sectors, Matt. Real estate still popping off. I took profit on that thing a couple of days ago, so I'm missing out on a few of these moves. Is that setting up for another entry point, by the way, on real estate XLRE?
Yes, it is. Yeah. I took the trade off right here 2 days ago. It's now coming back down, retracing back down into support. I'm not looking at making that trade right now. I think it could come down a little bit more, but yeah, it's on its way to set it up for another swing trade, no doubt.
Yeah, for sure. Whenever you get out of a trade on a profit, it's almost like your mindset is, I can't wait to get back in when it sets up, but you got to remember your rules. Use that change percentage on the Tackle 25. This is something I always do every day. Find that column and just click on the percentage symbol on the very far right. Yep. So the big movers today, obviously Tesla down, RCL up, Apple up, DHI up. Click on DHI and RCL. DR Horton, strong breakout setting up. And Royal Caribbean, potential breakout there at that 116 level. So a couple of levels to keep an eye on if you're trading that Tackle 25.
Well, and Tim, just over here at the Skyline, when people miss trades, it's when they don't go through their watch list and they don't do their routine. Right.
It's when they get into rants about Tesla and they forgot to check all of their stocks. That's when they miss their trading.
See, I can get into as many rants on Tesla as I want because I'm
after the routine.
Okay? Part of my routine is getting on a rant on Tesla right now.
I got
that's it. I feel hurt. Do you not understand that? I feel hurt. I love Elon Musk, and I feel like he lied to manipulate the stock price, and that goes against my fundamental principles. And I'm a principled individual.
What are your fundamental principles?
Take the good with the bad. But I will say this Skyline page is an absolutely fantastic way to do your daily routine on a daily basis.
Well, go up, and I'm going to also show one more value out of here, Matt, where it says trade journals. Guys, if you're out there and you don't have all of these journals, to me as a mentor, when I'm mentoring somebody one-on-one, the very most important journal is that Tackle Portfolio Journal. Okay. And this one where you kind of keep track of your overall portfolio totals is a great way to learn about how you've built your portfolio design. The Theta Research one on how you qualify the naked puts, like what you did last time in Mind of a Trader, and then your regular trade journal. So make sure that you're doing this all as a part of your routine.
Well, and Tim, the trade journal is where you journal every single trade. The Theta Research journal is where you do, research on naked puts, credit spreads, condors, whatnot, any Theta type cash flow system. But the portfolio journal is the journal you fill out at the very end of your trading day. So when you're done with your daily routine, which should only take 30 minutes, 30 to 60 minutes max, depending on what type of trader you are, when you're done with your daily routine, you fill out that portfolio journal, because then you can track your progress over time instead of randomly logging into your broker and being like, why am I up or why am I down? You have to, and the one thing I'll say to everybody is here, right? Treat this professionally. This is a business. You need to do your daily routine on a daily basis. That's why you come to the halftime report, so that we can help you do your daily routine. But do not fail to fill out those journals, because those journals are very, very important. And the simple reality, Tim, is we give our journals away to all of our pro members, right?
Well,
you just got to download them.
I mean, and the thing about it is, we have paid services, and I don't ever have any qualms, asking people to pay for good service, right? Our pro membership, things that we do, premium services. But it's most of that is just so that we can continue to grow our communities and whatnot, and, make sure that everybody has got skin in the game, but the value we bring, Matt, I'm very proud of, right? And hopefully you guys out there that are watching this kind of stuff, you see that, because it really is a passion. We love this stuff. We love tackle trading. And James says here in the chat, Matt, the rants pay the rent. Okay. I like that. There's nothing wrong with that, James. Very, very good. One last discussion, and quick one here. It's Nixon's 44th anniversary when he got kicked out of office. Well, you and I, before the show.
Technically, he did resign.
Right. Okay. Right. I mean, I don't know every day in history, but I'm pretty sure he got pushed out of office, right? It was a resignation. You're right. 44 years ago, in the 1970s, Nixon had a very interesting economy. One thing that is fun for me to do is to go back and look at how the market was at that time. And there's a really neat feature on Thinkorswim, the SPX, where you can put in all the data. So right here where you go to, actually click that again and go to time frame. Second box. And where it says 3 years, go down to max available.
Here's Nixon's, just looking at Nixon here.
Yeah. So starting there on the left, excuse me, is 1969. Talk about the economy that we saw at that time, Matt.
Obviously we're in the thralls of the Vietnam War, the thralls of the Cold War, which was more of a spending war than it was it was more of an economic war than it was anything else. It was a spending. Russia was trying to outspend us. We were trying to outspend them. It's very early in the late 1960s. Basically, Nixon and Kissinger created this plan, and the plan basically was to remove the gold standard from the equation to go to the petrodollar system. That plan was executed between 1971 and 1973. So in 1971, we left the gold standard. 1973, we adopted the petrodollar standard. From a foreign policy perspective, some people will say that was a bad thing. Some people will say that was a good thing. But I will tell you a couple things that did happen out of that. Number one, we were now able to print more money, spend more money. We became a debt-driven society more than an actual currency society. It basically kicked out Russia out of the Middle East, right? So Russia, the U.S. were trying to, banter for position in the Middle East, the oil-rich countries of Saudi Arabia, Kuwait, Iran, Iraq, Syria, and so on and so forth. That deal between Saudi Arabia and the U.S. and the other OPEC nations in 1975 basically removed Russia from the equation in the 1970s and allowed the U.S. to really kind of corner the Middle East. And, we've kind of seen what's happened out of that over the next 40 years. Don't want to do a little history lesson on that, but from an economic perspective, you were dealing with high interest rates, you were dealing with high unemployment. You basically had an entire economic stagnation for an entire decade. You had a misapplication of Keynesian economics in the 1970s, and it was really kind of through the 1970s and the misusage of Keynesian economics, which really fostered the neoliberal economic movement in the 1980s.
Yeah. 8 to 10 to 12% inflation at the time, Matt. I mean, I went back and looked up some of the data. It's not like I have this on the tip of my tongue all the time. I went back, and when I saw that we were going to talk Nixon, I went and looked it up. And they were dealing with 8, 10, 12% inflation. And he was a Keynesian, there's no doubt about it, but unemployment was high. The economy was not very strong. Some of that, we could blame on the politics, but I tend to not do that. He might have had a tough road there from that perspective.
Well, you're also talking about the tail end of Keynesian economics, at least the original version of Keynesian economics,
Sure.
right? Keynesian economics came from the 1930s, specifically John Keynes in 1932, who basically was this economist who argued that, we should modify capitalism to support recessions, depressions, and time of economic crisis. So every recession we went through, and you can kind of see this from a macro perspective, every time from the 1930s, and what you're looking at right here, Tim, is you're looking at the Great Depression, 1929, the market, and again, this isn't a one-to-one apples type scenario, but if you're looking at the market going down, you're talking about 90% devaluation over the course of, 2-3 years. So in 1932, right here at the bottom of the market, John Keynes writes a book, and he basically says to FDR, listen, capitalism is great, but it's not without its flaws. And the flaw in capitalism in times of economic crisis like the Great Depression is consumers will not spend their money because they, number one, don't have a job. Number two, don't have money. And even if they did, they're going to hide the money in the first place. So if consumers are not going to spend their money in times of crisis, it is government's responsibility, according to the social contract, to step in and support the economy. And that's what Keynesian economics is. And we call them bailouts today and stimulus packages today, but that's basically Keynesian economics. And as you can see, every time we went through a recession from that point forward, the next recession, Tim, 1936, every time we went through a recession after that, we threw money at the problem every single time. So here we're throwing money at the problem, money at the problem, money at the problem, money at the problem, but we're talking debt, not money. So we go into more debt, more debt, more debt. So by the end of the 1960s, early 1970s, we were basically we didn't have money, we didn't have debt. We'd thrown everything we could at it because we were the dollar standard, the gold standard. And when you're the gold standard, you can only print the amount of money relationship to the amount of gold you have at $35 an ounce. So what Henry Kissinger did in the 1970s was he said, okay, let's remove the gold standard from the equation so that we can print even more money. So instead of printing against gold, we are now going to print against debt, which will allow us to expand our debt-driven economy. And so basically that sparked a little bit of hyperinflation, 10, 15% inflationary impacts. And for those of you who were not around during the 70s, I was born in 1977, but Tim, I still remember in the early 1980s, mid 1980s, how, inflation was still fairly big. I mean, Tim, do you remember when Dad would have us go put locks on the gas can?
Yeah.
And I mean, that's because the inflationary impacts. So Henry Kissinger, Richard Nixon, they basically inherited a system that was broken. They did what they could to fix it. Now, I disagree with removing the gold standard from the equation. I'm not saying I'm a supporter in that, but they did inherit a situation in the thralls of the Vietnam War, in the thralls of high inflationary rates, mismanagement from an economic perspective. And so they inherited this, but it really fostered that neoliberal movement that came in the later 1970s with Ronald Reagan, Alan Greenspan, these neoliberal, neoconservative type individuals who, brought trickle-down economics, and basically they to crush inflation. Not Henry Kissinger, but Alan Greenspan now basically said, okay, well, let's go to 18, 24% interest rates. Let's crush the inflationary impact. And then that fostered in the neo-capitalist movement, which basically has seen more growth in the last 35 years than the previous 200 years combined.
I'll tell you this. All of it has got me thinking. I've got my weekend reading. I'm going to go find something to read about Nixon or see a documentary on Nixon.
I'll tell you, Tim.
Fascinating.
Nixon's an interesting historical character because we look back at Nixon to Watergate, right? And we see Nixon as this guy who was, basically, blacklisted from that Watergate perspective. But Tim Nixon also, was also negotiated the SALT Treaty, right, which was a nuclear arms treaty with Russia. He also negotiated free trade deals with China. He also, fostered other type of domestic programs. Nixon had some key achievements out there that are quite fascinating, quite frankly.
Yeah, I mean, he was a patriot. He was a veteran. He was an interesting person. He was a football player. He loved poker. He then became a career politician, obviously, one of the most successful ever. I mean, he made it to the highest office in the world. He also was an anti-Semite.
Nixon would have been president instead of John F. Kennedy in 1960. Okay.
Yeah.
In 1960, it was going to be Richard Nixon. He was going to be the president of the United States until that good-looking son of a gun, JFK, got up in one of the first live debates ever. And then all of America sees this amazingly handsome man who is articulate, Northeastern guy, comes in, just wows everybody. And all of a sudden Nixon gets beat because Nixon looked like this old fart on the TV screen. JFK standing tall, Nixon sweating. And so Nixon was a highly successful politician for decades and decades and decades. It's a very sad ending to his career, obviously, when he got paranoid with Watergate and so on and so forth. But looking back from Nixon, I certainly wouldn't put him into the top president category by no means in any capacity.
No, I mean,
a bad president. But
there's some good things he did, though. You know, him touching down in China in 1972 and actually starting to open up the conversation with China. China's been one of the leading economies for several decades now for a reason. You know, everything that we're doing right now with these Chinese tariffs, I mean, we might want to look back at history and see how negative that relationship was for a long time. I think we should foster it, not start throwing gas on a fire there, but that's another conversation.
I think we should try to foster all economic growth with most countries.
Yeah. Yeah. But then, I mean, his expansion into the Vietnam War, his failure there, a lot of the stuff.
He also ended it, though, with the Paris Treaty in 1973, Tim. So again, I mean, you want to talk about blame
Complex.
Here. It wasn't really Nixon that saw that big increase. It was Johnson who saw the big increase. And it was JFK before Johnson, Lyndon B. Johnson. It was JFK who started putting in those advisors, 20, 30, 40,000 advisors, which were really military personnel as far back as the early 1960s. So, you know, I mean, I get it. We did see a massive expansion in 68, 69, 70 in the Vietnam War. But it was Nixon who did actually sign that treaty to end the Vietnam War in 1973.
You know, whenever I think of Nixon, I think of my wife's grandpa, because when I married into this family, I would talk.
Appreciates that.
Well, I would talk. He loved Nixon. He's a conservative man who was a builder. He's a plumber, and he was also an immigrant. And he was, when I met him, he had to be 75 years old. This is 15 years ago. He's passed a few years now. And whenever we would sit and talk, he would have, and this is what I loved about him, is nobody else would talk politics with me, but he'd just come over and grin and say, "Hey, what do you think of Obama?" And I'd say, "Oh, well, you know, this and that." And we'd sit and talk, and I'd get to talking about history. And he was willing to have a different opinion, different take. And Nixon was his favorite. There's no doubt about it. He represented a blue collar guy. And I think the fact that he was a veteran was a big thing for Grandpa. I love history. I love politics.
I think we get so nasty from a political perspective in 2018. We live in a very horrific political environment. But I think if you look back on history at almost every president, I don't think a president comes in to try to do a bad job. Right? They come in with their agenda. They believe in America. They believe in what they're trying to do. You may disagree with them. You may agree with them. But I think if you look back in history, I think you can look back to George Bush's times and you can say, okay, you know, there was some good, there was some bad, right? I think you can look back to Obama and say, you know what? There was some good. Obama inherited one of the worst economic environments in the history of the United States. Right. It kind of like FDR did in the 1930s and kind of like George W. Bush did in the early 2000s. When you inherit something like that, you know, and you find, you know, some support and the market starts appreciating, you can look back and say, okay, listen, you might not like Obama, but the economy did turn around. The market did start price appreciating. And even though that was more central bank driven than presidential driven, you can look at some positives and some negatives. Same thing with Reagan. You know, I'm a big fan of Ronald Reagan. I think he was an absolutely wonderful, great president, but that doesn't mean there wasn't some bad things about Reagan as well. Same thing with Nixon. So when we're in the thralls of this, you know, political environment we're in today, remember that we're always going to have agreements. We're always going to have disagreements, but as long as we always try to strive for greatness and try to push, you know, what we believe is better, then that's a good thing. That's a good thing. Let's just do it in a respectful manner.
So I'm going to watch a Nixon documentary. I'm going to listen to some of Bill Clinton's old jazz music where he used to play the saxophone. I'm going to look at some of George Bush's paintings. But the first thing I'm going to do is get some lunch. Guys, that's been our halftime show here today. Love having you here. If you're still listening and watching, we love you. Give us a thumbs up, give us a share, and make sure you get over to Tackle Trading and join our communities there so we can deep dive into this trading stuff and really make an impact on your life, and get you out there and doing stuff. Matt, great job today. Cody, great job on the prep today. Love the Nixon call on that. And, Cody, you just keep getting better each and every day, kid. That's what I want to see from you. Matt, we're out.
Later, guys.